Friday, June 16th. I have an incomprehensible report for everyone. The Fed concluded a two-day meeting on Wednesday, raised the overnight cost of money again, now to a band of 1% to 1.25%. That's the second time this year, the third time since last December, since the election, and each time the Fed has raised the short-term cost of money, long-term rates have come down. So mortgage rates are lower now than they were before Wednesday and before each of the other two Fed rate hikes. So one lesson for those who are still with us, the Fed manipulates the overnight cost of money and long-term rates have a mind of their own. There was a secondary tip-off this week that should have more heads spinning than are. First thing Wednesday morning, 4 hours before the Fed moved, we got news that oil prices had tanked, had dumped back down under $45 a barrel. The Saudi measures to control output having failed completely. U.S. inflation fell, both in the month of May and as measured year over year. And auto sales finally fell. The drop in long-term rates came 4 hours before the Fed. I've seen an awful lot of Fed meetings in the last 40 years, and not once can I remember a drop in rates before the meeting. Now, there are times when they do for peculiar reasons after the meeting, but not before. That says, very loudly, that if it were not for the Fed pushing up on short-term rates, long-term rates would be a lot lower, maybe 0.5% lower, maybe lower than they were before the big spike upward on election day. So shift to why, among other things, and why in any case, before or after the meeting, would long-term rates fall while the Fed is raising short-term ones. And the most common answer, and it's been a very reliable one, it goes back a very long ways, and in economies not just ours, is the signal that the Fed is overdoing its tightening is a drop in long-term rates while it's hiking. That's long-term money deciding that the economy is going to tank, good time to buy bonds, interest rate, long-term rates go down. That's not what's happening. The U.S. economy is doing fine. So back to square one, what is happening? The European Central Bank and Bank of Japan together are buying $150 billion per month of long-term bonds in an effort to get Europe and Japan to grow faster. In the case of Japan, to get it to grow at all. And so there's a perverse relationship between the Fed and the other central banks. The other two big ones are easing like crazy while our Fed is trying to normalize. So that puts downward pressure on long-term rates. So enjoy them while we will. Mortgages are sitting around 4. And there's one more shoe that fell, which is the Fed, in an effort to get us out, the Fed in an effort to keep the Great Recession from turning into a depression, in a series of 3 quantitative easings, acquired an extra $3 trillion or so worth of treasuries and mortgage-backed securities. The Fed would now like to unwind that balance sheet, and they don't intend to sell them for fear that that might do damage, but as each mortgage and each treasury bond matures, the Fed has been using the money at maturity to buy another bond, to keep its balance sheet stable. Beginning probably in September, the Fed will stop reinvesting, begin to, at a known forecasted slope. Now, the treasuries that the Fed will let run off of its portfolio, well, they'll be easily absorbed. I mean, the treasury market is global, deep, wide, but the mortgage-backed securities market, that's more a domestic market. It's shallow. The Fed each year for the last 8 has bought almost 40% of new mortgages produced. And I have some question about just exactly who it is that's going to buy those as the Fed steps out as a buyer. So here's a hunch. I wouldn't dignify it with a forecast. Long-term rates have probably bottomed here. They're not likely to rise in a blaze. No central bank has ever tried to unwind a balance sheet as big as the Fed's. How that goes, especially with mortgage rates, we're not going to know until fall. But the Fed's statement and announced policies of continuing to raise short-term rates, let the balance sheet run off, I think we're going to see a gradual increase in mortgage rates. And it'll be the first gradual increase in mortgage rates in 15 years. And how all this goes, see every Friday.